Hi, I'm Jimmy. In this video, we're going to look at how the US economy really looks today. We're going to use a few different economic indicators that are interesting to see what they can tell us. We're going to look at things like inflation, mortgage rates, manufacturing, shipping, things along those lines to see how strong or weak the economy really is. And hopefully when we look at this real data, well, we'll have a better understanding of the overall economy and be able to look past so much of the economic noise that's out there. Okay, one quick interruption. I'm actually very proud to announce that this video is sponsored by a sponsor we've represented in the past, and that is the Borsa Earnings app. Now, what this app does is it lets you stream any earnings call on the go. It's sort of like listening to a podcast. The earnings calls become that simple. Now, one thing I like about it is you get to listen to the tone of management. When you're analyzing a company, you get to listen to the tone of management. And this app, it's free. This makes it simple. This app is used by money managers, analysts, retail investors. They were featured on CNBC. This is a really great app. I'm really proud that these guys are supporting the channel by sponsoring this video. So if you can, show them some support. Like I said, it's free. I'll leave links in the description below to that app. So if you can, go over, download it, let them know I sent you. Thank you, and back to the show. Okay, so let's jump right in. Now, typically when I've done these types of videos, I've called this invest now, should we invest now or wait for a stock market crash? But clearly, it's time to change that title since timing the market is very unlikely, let's call it. Instead, let's just consistently invest and see if we can use information like the stuff we're looking at today to help guide our investments. Now, that being said, in the last video, I actually we looked at some sectors that could be undervalued. One of them that appeared like they could be undervalued was the materials sector. Well, I have been going through that sector for about a month, and I haven't found many companies that look all that undervalued. So I'll keep looking, but for now, there doesn't seem to be a lot there. Okay, let's jump in for real this time. So let's start with housing, and let's kick it off with mortgage rates. So this is a chart of mortgage rates going back the past 10 years. This is the average 30-year fixed mortgage rate for prime borrowers. So basically, this is from a bank's perspective, ideal buyers with great credit. And we can see that for a few years, rates were sort of in a range. Then 2020 happened, and the Fed started dropping interest rates. As so often happens, mortgage rates went along with it. So, is this a good thing for the overall economy? Generally, lower interest rates lead to more economic activity. So, lower rates they do tend to be a good thing for the overall economy. Now, are they too low? Well, that depends on how long they stay down here. We will have to see when that changes. But for now, this is a positive sign for the economy. Now, if you've ever wondered where mortgage rates come from, well, generally they tend to be tied to other interest rates. One similar rate that we can watch is the 10-year Treasury rate. Now, obviously, mortgage rates are higher, but just to illustrate, if we overlay the 10-year Treasury on top of this 30-year mortgage rate chart, well, we can see that the two move very similar to each other. So if you're ever thinking about getting a mortgage, you can watch the 10-year Treasury to sort of gauge roughly how mortgages are moving. Okay, so over on our scorecard here, well, the first point goes to the bulls. Right now, the bulls are winning 1-0 because lower mortgage rates tend to be good for the economy. Okay, now sticking with housing for a second, now we've got housing starts. So this is the number of new houses being built. And clearly, more houses being built does a whole bunch of good things for the economy. This is a positive sign for the broader economy. So this is going to be a point for the bulls. And along these same lines, sticking with housing, this is the price of existing home sales. And clearly, again, the trend is higher for home prices. Now, I've hesitated on this one for a while. Last time we did a video like this, I made this a neutral point saying, all right, you could argue it either way. Ultimately, the more I've looked into this and the more I've researched the impact of rising home prices, especially big jumps like the recent number, well, it's a bad sign for the economy. Too rapid of a jump in home prices is going to slow down what the economy can do. So I think it's fair to give this point to the bears. So over in our scorecard here, we have a point for the bulls for more housing starts. That's a good thing. And a point for the bears for the increase in home prices. That's a bad thing, at least at rapidly increasing home prices. Okay, now let's take a peek at manufacturing. So this is the manufacturing index, this is put out by the Institute for Supply Management. You might hear it called the ISM manufacturing indicator. And basically, higher is better here. Anything above 50 implies positive growth, below 50 is negative growth. So the fact that we're up near 60 is a good sign. This is clearly going to be a point for the bulls. Okay, now we've got an interesting point, another angle on the manufacturing sector, and that's shipping. Specifically, the shipping of raw materials. So this is the Baltic Dry Index. We've looked at this one in the past, but it's been a while. So this measures the cost of shipping goods. Now, generally, we're primarily talking about commodities. Things like iron ore, coal, grains, the stuff we would use to make other products or to fuel factories or whatever it is. These are mostly raw materials. They do measure a few other products, but it's mostly raw materials and it's global, all over the world. And we can see that in early 2020, things got a bit nuts. There wasn't much demand, so prices dropped. But recently, the global economy has been recovering, and we can see that the Baltic Dry Index has also seen a healthy jump. So this confirms the point that we saw in the ISM manufacturing indicator that manufacturing seems to be strengthening around the world. So that's going to be 2 points for the bulls. Okay, now let's take a peek at the Treasury yield curve and inflation. Okay, so this is what the Treasury yield curve looked like last February, so February 2020. And this is what they call an inverted yield curve. And this is what the yield curve actually looked like. I took these numbers from the day, it was the peak of the stock market right before it began to tumble. So this is an inverted yield curve because short-term rates are higher than long-term rates. So this means if we bought a 3-month treasury, well, we would earn 1.58%. But if we bought a 10-year treasury, we would earn 1.57%. This is backwards. We're supposed to earn more money or a higher rate of interest the longer we invest. Who would lock up their money for 10 years when you can lock up your money for just 3 months and earn a higher interest rate? Now, I should also point out that all these numbers are annualized. So 3 months, it's actually a quarter. You get a quarter of that, and they just multiply it by 4 to make it an annualized number. And you're not earning 1.57% over 10 years. You're doing that each year on an annual basis, just so we're all on the same page. Generally, wherever you look, interest rates will be annualized. Either way, the point still stands. We are supposed to earn more money for longer-term investments. Now, as we fast forward, I'll let these scroll through time from month to month until we get up to today. And we can see that the yield curve the shape has gradually corrected itself. It is supposed to be upward sloping like that. Now, a lot of this happened because when 2020 happened, when COVID happened, the Treasury or the Federal Reserve came out and started lowering short-term rates. As they start hammering down those short-term rates, the yield curve normalizes as it's supposed to. Now, I also think it's important for us to recognize that the Federal Reserve doesn't directly control any of these rates. These rates are set at auctions. And so it's a really supply and demand thing. If the Fed controlled these rates, they would never let it invert. Now, while they don't control these rates, they do have a serious impact, especially on short-term rates. They actually control an overnight rate. So if they lowered the overnight rate by 1% like they did when COVID happened, well, that automatically forces everything else to come along with it. But they did not raise interest rates, and we might have noticed on the 10-year Treasury before that actually went up, and they never raised rates. That was a market thing that caused that to happen. Okay, either way, as we get to today, well, we can see that since February of last year, well, the yield curve has been normal. So, and that's because, again, short-term rates are lower than long-term rates. And that's exactly what we want. So this is going to be another point for the bulls. The yield curve is heavily relied on by many economists. So the fact that this has been positive for a long time is a very good sign. Okay, so over on our scorecard here, we can see that things are looking quite good. But now this brings us to inflation. So this is a chart of the inflation rate, at least the inflation rate that the Federal Reserve uses. I understand there are other ways to look at this. I'm taking the way the Federal Reserve uses it. And we can see that there has been a huge and very fast jump in inflation in recent months. We can also see that right now it is at the highest level in the past 10 years. This is a 10-year chart. Now, I actually checked. I was curious the last time I was up here. And in July of 2008, right as the financial crisis started happening, shortly after the stock market began to tumble, was the last time that inflation rates were up at this level. Now, if we go and read about inflation at all, we may recognize that the topic of inflation is very heated amongst economists. The Federal Reserve themselves right now are saying that they believe this inflation that's happening right now to be transitory, which basically just means short-term inflation. It's inflation that will naturally correct itself in hopefully the near future. Now, I've been reading, trying to understand why they're saying that. And some of the data behind the inflation numbers, I can logic out why they would say something like that. Some of it I could easily argue against. I could easily argue that it's the creation of trillions of dollars that brought on this type of inflation, not the economy opening back up. Or even if it is the economy opening back up, it's the economy opening back up with trillions of dollars behind it. Now, I'm not suggesting that the Fed isn't saying that the money that they've created isn't playing a role. I just think that they might be overlooking that this might not turn around in the near term. So going back to our scorecard here, clearly inflation is going to be a point for the bears since this is a bad thing. Either way we slice it, too much inflation is a bad thing. And we're there now. It's at that point. And there's a good chance that this could get worse. I think that as strong as the economy looks, and many parts of the economy, we can see it, many parts of the economy do look strong. But this inflation thing is a big deal. Just to illustrate, when we look at our handy-dandy scorecard here, well, let's pretend inflation keeps ticking higher. And the Federal Reserve eventually sees that, and the longer it sticks around, the more likely they're going to have to do something about it. Well, what can they do? They can raise interest rates. And if they do, that's going to put a ton of pressure on mortgage rates. We already saw the correlation between treasury rates and the mortgage rates. Well, if that happens, that's going to be a bad sign for housing starts, since surely less houses are going to be built. Housing prices probably pull back, although it's possible they move sideways, so we'll call that one, we'll just leave that where it's at. Manufacturing and shipping in general will say that depending on how fast they raise interest rates, I think that would affect them somewhat. Rising rates would slow all sorts of economic activity. But again, we'll keep those neutral for a moment and assume that they can hang in there. The yield curve, well, if the Fed increases rates, don't forget they're increasing overnight rates, short-term rates, it's very possible that the yield curve tilts back in the wrong direction. And who knows how quickly they have to increase interest rates. So if they have to do a serious rate increase, 1%, 2%, 3%, I don't think 3% would happen, but 1% is certainly on the table. If that were to happen, well, what do long-term rates do? And again, the yield curve could be in trouble quickly. Basically, what I'm saying is that if inflation goes unchecked, well, that could have a very drastic ripple effect on the entire economy. So what once appeared to be a very strong economy could suddenly see a whole bunch of problems pile up very quickly. And that's because the foundation of a solid economy is that there are no real drastic moves in inflation or housing. As long as everything steadily moves along, it tends not to trigger any major fear events. Now, of course, I don't think this changes at all the way we should invest. If anything, we can consider getting a bit more defensive if we're worried about the fact that the stock market's overvalued and inflation could become a problem. But it's certainly not a reason for me to sell any of my stocks. I plan on holding those for many, many, many years. So I'm not suggesting that for 1 second. But with this information, that doesn't mean we can't do things to strengthen our portfolio. Do we get some defensive names? Perhaps some names that do well in higher inflationary environments. Some dividend stocks, maybe. Now, I recently did a video called I called it the best dividend stocks in stock market crashes. We looked at different stock market crashes, found good dividend stocks. Maybe that's a good place to start. So if you're curious, perhaps that's a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.